Don't be fooled by the flashy headlines celebrating 10% credit cards and 6% mortgages. Don't buy into the hype about falling interest rates. And definitely don't believe anyone who tells you this is a win for the American consumer. What you're watching unfold in January 2026 is the most dangerous monetary experiment in modern American history. The most reckless since Richard Nixon took the United States off the gold standard. The President of the United States has launched a direct assault on the price of money itself. And when governments start manipulating the cost of credit for political advantage, history teaches us one brutal truth. Someone always pays, and most of the time, that someone is you and me. Stock prices no longer reflect corporate performance. Home prices no longer reflect supply and demand. Interest rates no longer reflect risk. Everything, and I mean everything, now reflects just one thing: the president's determination to win the 2026 midterm elections. Welcome to the age of political money. Welcome to the great repricing. And if you don't understand what's happening right now, you're about to get crushed. Let me show you what's happening in Washington. On one side, you have President Donald Trump, fresh off his 2024 election victory, and staring down the barrel of the 2026 midterms. His political survival depends on one simple mission: making Americans feel like life is getting cheaper. Credit card debt has reached $1.3 trillion. The average APR sits at 21%. Mortgage rates were hovering near 7%. Voters are angry, and they want relief. On the other side, you have Jerome Powell and the Federal Reserve, an institution designed in 1913 to be independent from political pressure. The entire purpose of the Fed is to make unpopular decisions, to raise rates when inflation runs hot, even if it costs a president an election. That firewall is now burning. On January 15, 2026, the Department of Justice served grand jury subpoenas to the Federal Reserve. Officially, it was about cost overruns in the renovation of the Eccles Building, the Fed's headquarters. But everyone in Washington knows the real reason. It's a pretext. It's the legal groundwork to remove Jerome Powell for cause before his term expires in May. Here's what you need to understand. Under the Federal Reserve Act, a president can only fire a Fed chair for inefficiency, neglect of duty, or malfeasance. Policy disagreement doesn't count. But if you can prove something, anything, that smells like misconduct, you have your opening. This isn't speculation. This is the playbook. And the markets understood immediately. Within 48 hours of the DOJ announcement, gold surged past $4,600 an ounce, a new all-time record. The dollar weakened against the euro and the yen. Bond traders started dumping U.S. treasuries, not because they feared inflation, but because they believed the Fed would be forced to allow it. This is what analysts call the sell America trade. It happens when global investors decide that U.S. assets now carry a political risk premium. Let me repeat that. Political risk premium, a term once reserved for countries like Turkey, Argentina, and Venezuela. Now it applies to the United States of America. On January 20th, 2026, exactly 1 year after his second inauguration, President Trump's credit card interest rate cap takes effect. The number is simple: 10%. No credit card in America is allowed to charge more than that. It sounds beautiful, doesn't it? A victory for the little guy against greedy Wall Street banks charging 25% or 30% interest. But it's a trap. Here's how credit card pricing actually works. The base cost of funds for a bank is tied to the prime rate. Right now, that's 6.75%. A 10% cap leaves just 3.25 percentage points of margin. That margin has to cover credit losses. For prime borrowers, maybe 2 to 3%. For subprime borrowers with FICO scores below 660, default rates can exceed 10%. Then there are operating costs, customer service, fraud detection, transaction processing, another 2 to 3%. Banks also have to hold reserves against these loans. And those airline miles and cashback points? They're funded by interest income. Do the math. A 10% cap doesn't work. Not even close. The American Bankers Association ran the numbers. Under a 10% cap, between 82% and 88% of all credit card accounts become unprofitable. Not slightly unprofitable, deeply unprofitable, existentially unprofitable. And when an account costs a bank money, they close it. Here's the part that should terrify you. The 47 million Americans with subprime credit, FICO scores below 660, they're not going to stop needing credit. When your car breaks down and you need $800 for repairs, you can't wait 6 months to save. So where do they go? Payday lenders. Effective APR, 300 to 400%. Pawn shops. Title loans that put your car at risk. And in the worst cases, illegal loan sharks. The cruel irony is brutal. A policy designed to protect consumers from 25% interest rates will push millions into 400% interest rates, or worse, into the hands of people who break kneecaps instead of charging late fees. Dr. Samuel Gregg of the American Institute for Economic Research said it perfectly. We are creating credit deserts for the people who need credit the most. And it's not just Wall Street banks. Credit unions, member-owned institutions that serve underserved communities, have come out swinging against this policy. In a letter to the president, they called it devastating. These aren't J.P. Morgan executives protecting bonuses. These are community institutions warning that they'll be forced to stop lending to their own members. And those airline miles you've been collecting, those 2% cashback cards, gone. The rewards ecosystem is funded by the cross-subsidy from borrowers paying high interest. Kill that revenue, and the entire system collapses. Every free flight, every hotel upgrade, it's been paid for by someone carrying a balance at 24% APR. Now let's talk about housing. On January 8, 2026, President Trump ordered the Federal Housing Finance Agency to direct Fannie Mae and Freddie Mac to spend $200 billion of their retained earnings buying mortgage-backed securities. The goal was simple: flood the market with demand, drive up bond prices, push mortgage rates below 6%, and it worked for about a week. Rates dipped below 6% for the first time in 3 years. Headlines celebrated. The president took a victory lap. But here's what those headlines didn't tell you. Fannie Mae's net worth as of Q3 2025, $105.5 billion. Freddie Mac is smaller. Combined, these institutions, which backstop the entire U.S. housing finance system, hold roughly $170 to $180 billion in capital reserves. The president just ordered them to spend $200 billion. He's spending more than they have. Since the 2008 financial crisis, Fannie and Freddie have operated under strict capital rules. The whole point was to build a safety buffer so taxpayers would never have to bail them out again. That buffer is now being burned to buy votes in a midterm election. There's another casualty here. For years, conservative economists pushed to privatize Fannie and Freddie. That dream is now dead. No private investor will put money into institutions where the White House can seize reserves on a whim. But here's the real trap. Mortgage rates affect demand. When rates fall, more people can buy. But what about supply? The U.S. housing market is millions of homes short. And there's the lock-in effect. Homeowners with 3% mortgages from 2020 and 2021 aren't selling. Why would they trade a 3% loan for a 6% one? So when you inject $200 billion of demand into a market with fixed supply, prices go up. That's basic economics. The benefit of lower rates gets eaten by higher prices. You're not helping first-time buyers. You're making existing homeowners richer and pricing the next generation out. Redfin economists estimate rates may fall by 1/4 to 0.5%, but home prices could rise far more. It's a shell game. Now, zoom out. What happens when interest rates become political? Inflation is near 3%. The Fed's target is 2%. The textbook response is to keep rates high. But what if the president forces cuts? Cheap money keeps zombie companies alive. Firms that survive only because debt is cheap. They don't innovate. They don't grow. They just consume capital. In a healthy economy, weak firms fail. Resources move to strong firms. It's painful, but necessary. When rates are suppressed for politics, zombies walk forever. Bubbles inflate, and when the crash comes, it's catastrophic. This is exactly what happened in the 1970s. Nixon pressured Fed Chair Arthur Burns. Inflation exploded. It took Paul Volcker and 20% interest rates to stop it. We're walking the same path. So what does 2026 look like? Financial repression. Keep interest below inflation. Force savers into negative real returns. A hidden tax on anyone holding cash. Savings accounts are projected to fall to 3.7%. If inflation stays near 3%, your real return is zero. So you either lose purchasing power or chase risky assets. And here's the cynical part. America has $34 trillion in debt. Negative real rates make that debt easier to manage. Inflation pays it down. Savers take the haircut. This is the great repricing. Money is no longer priced by markets. It's priced by politics. So how do you protect yourself? Cash is no longer safe. Hard assets matter. Gold is rising for a reason. Real estate holds value when currency doesn't. Diversify globally, reduce debt. Because when politics controls money, history shows how this ends. These are called managed economies, and they rarely end well. The question isn't whether the mistakes of the 1970s will be repeated. The question is whether we learn before the damage becomes irreversible. I'm not optimistic, but I am prepared. And you should be too.